So you'll be able to obtain a copy of the recording after the content that we go through today. And really, this is meant for you all to get the most out of it. So please do not hesitate to raise your hand, put a question in the chat. We want to make sure that everyone gets the most out of our conversation today. What is that conversation? We're going to be talking about mid-career money moves. So really, this is targeted at folks that are, going from the kind of basic position of needing to save and maybe starting at a beginning portion of your career to there's more complexity in your life, and how do you manage that with confidence? And so what we're going to talk about today will be a quick introduction to who I am. We're going to introduce the topics we'll cover: savings and debt, investment options and strategies, and we're going to finish with 3 goals that you can implement from our conversation today to have a lasting impact on your financial decisions into the future. We will also leave time at the end for closing questions. So we want to make sure either you get your questions answered in real time, or you can also save them for the end. So very excited for what we have covered today. This is a jam-packed webinar. I hope you all get a ton out of this. Please stop me. Please ask questions. We're here for you. So who am I? I am Will Ham. I am the CEO and founder of 27T Financial. And I started 27T Financial with the core purpose of our organization to help close the $27 trillion retirement savings gap. And I truly believe in creating education opportunities and helping others make strong financial decisions for themselves will help create the benefit of closing that retirement gap. Why listen to me? At the end of the day, I've spent about 10 years in the financial services industry. I've worked at large organizations like John Hancock on the retirement platform side, so I understand the behind the scenes nuts and bolts of interacting with platforms, how to get the most out of them, as well as spending time at Fisher Investments on the financial planning and portfolio management side, and working individually with clients to maximize their financial plan and investment allocation. Most of you know me as the 401k guy. I work with the organizations that you are employees of and help the company manage and run the 401k, as well as providing education and advice to you all as employees of that retirement plan. I'm also going to cover how we can work together on an individual basis if this sparks questions or maybe specific situations that you don't feel like asking questions to a large group of people. There will also be an opportunity to schedule individual one-on-one time with me. So what is this conversation today going to be about? It's really meant for those individuals that are reaching the complex stage of their career. Maybe you're balancing children, maybe you have a mortgage to pay, maybe there are some outstanding loans that you have, and or dealing with aging parents or grandparents that you're not sure how to do that or what to do. It's a very different situation today than when you started your career. Maybe you're just figuring out how to pay your bills and how to save for the first time, and your life is getting increasingly complex. And so from my perspective, as complexity enters your life, it's good to have a framework to work within. How do you organize and create that framework to help you make decisions? And rarely is there an opportunity for it to be absolutely perfect. But what we want to do is give you the strategies that you can put in place to say, okay, I've got my arms as far around this as I can, and I know I'm making the best decisions for myself. How are we going to do that? We're going to talk about savings and debt management, budgeting, as well as how does creating a budget play into your long-term retirement savings goals? And then making sure that once you have a good understanding of your full financial picture, how do you make sure that the investments in your portfolio are matching those goals that you have for yourself? Oftentimes, as you reach this stage in life where you have various number of complexities and responsibilities, your investment allocation can change from when you started in your career. So how do you think about making those adjustments, and how do you understand what's right for you? So I mentioned this earlier, really, we're shifting from just that savings mindset to strategically investing and protecting your financial picture. And the goal here today is to give you some simple ideas that you can implement tomorrow that are going to have lasting impacts over the next 20 to 30 years. I'm a big proponent of you don't have to change everything. How do you stair step your way into the right environment? Because that over time will have these huge lasting results and also create the opportunity to stick with those goals. So, what's going on from a mid career saver perspective? I mean, everyone's going to have their own unique situation here. And when I'm viewing everybody on this call, everyone's going to be in a different spot. Maybe folks are looking or thinking about having children, or maybe you just had children and you're not sure how to set things up financially for yourself and for your kids as you transition to that provider stage in life. Maybe you've just purchased a home or are looking to purchase a home. Maybe you've been crushing it financially and you're saying, hey, I would really love to have a vacation home that I can take our children or family to for the next 10 to 15 years. Maybe it's caring for an aging parent, or with where interest rates are and housing prices are today, maybe it's, hey, I'm going to stay put in my house, but we want to update things and make some changes. All of those have big financial impacts to you and can create uncertainty from a financial planning perspective as an individual going about this alone. So how do you implement strategies to make sure that as your life changes, as your goals adjust, what you have in place, that foundation of saving, can do and help you? So what we're going to talk about first is smart savings. What I mean by smart savings is, how do you get an idea of, am I doing the right thing? Is all of my money going to where I want it to be? And we like to put that into three buckets. You want to think about short-term savings, mid-term savings, and long-term savings. Short-term savings being easily accessible, opportunities to tap into some cash potentially. Midterm savings would be items like buying a home, saving for children's college, big vacations, or plans to your home. And long-term savings being the 401k component, investing and planning for retirement. And so those are going to be the key components of your savings strategy. So before I go any further, I'm going to put a poll up here. You're going to see this launch here on the screen shortly. I ask that you answer the question. And what we're looking at is, I'm asking you, what bucket feels the most important right now? Is it emergency savings? Are you unsure how much cash you want? Is it retirement savings? Am I saving enough for retirement? Do you have large home or children goals? Or quite frankly, is it all of the above? And I want to make sure we spend the most amount of time on the topics that are important to you here today. So take just a few minutes to answer this question. I've already seen some great results coming in, and we will just give you another minute to fill that out. And once everyone's done that, we'll move on to the next slide. All right. So we've got just about everybody in here, and we've got a mix of key topics across the board. So we've got all the above: emergency savings, retirement, debt management. Home and kids goals aren't necessarily something that everybody on here is strategically thinking about. So we'll spend a little bit less time on that, still giving you the foundation, but we'll spend a little bit more time on retirement and emergency savings and debt management as well. So thank you everybody for participating in that. And what we're going to do is jump into how to budget your savings goals. And I like simple processes that can mold and change with what's going on in your life. And so, really, our key component here is how do we put foundations in place that can grow with us over time? That's why I love the three bucket strategy here. So, at a high level, what you want to be thinking about is from a savings perspective, about 50% of your savings going to essentials, 30% to wants, and 20% to savings and debt. And this is a good framework to work within. Now, these can be malleable. You can kind of make adjustments to that to fit your specific need. Maybe sometimes essentials make up 60 or 70% of your overall budget because you moved into a house that you're planning to grow into. Or maybe you've got a number of trips coming up that you've always wanted to take that are on your bucket list, and you've lowered your essential costs over time to be able to pay for those. Maybe your wants go up to 40%. Or maybe you've paid down all of your saving or all of your debt and have done a great job saving, and you can pour more into that wants. Maybe you dial that back to 10%. I think that's the beauty of this three bucket strategy is you can make this specific to you, but we want to give you the foundational pieces to be able to do that for yourself. So, essentials. What are essentials from a savings and budgeting standpoint? Well, it's your everyday costs, right? It's the cost of doing business of who you are. It's mortgage, it's rent, car payments, putting food on the table for you and your family, electricity, utilities. Think of these as your bills that if you don't pay them, it's going to create a lot of heartache. And so we want to make sure that this is your number one foundational piece from a budgeting standpoint, making sure you've got a good handle on where those costs are going and how much of your annual income is going towards those essential costs. The good rule of thumb is about 50% of your income is going towards those essential costs for your budget. And making sure that if that goes above or beyond that, you're able to pull from one of the other ones that are a little bit easier or can be put off for down the road. Wants. So how do we categorize a want? Well, that's, hey, we're going out to eat. I love going out to eat with my wife. We spend at least one date night out a month, making sure that we connect. Well, that's part of our 30% want bucket. Entertainment, whether you like going to concerts or potentially going on vacations, these are the fun things in life. This is what adds the flavor to the overall meal. And so, really, I think it's a key component, but also can be a very big budget item for you, right? You don't have to be clipping coupons and skipping Starbucks every day because it's something that you enjoy and something that's important to you. You just want to make sure that if you're doing those things, it fits within your framework. And so I think wants is such an important component of a sound budgeting exercise because it will allow you to stick with this over time. If you have an idea of where your money is going, it makes it easier to say, hey, I'm not going to stress about going out to eat, or I'm not going to stress about enjoying vacation with my family because I know that we've got this under control. And then budgeting, savings, and debt goals. So think of this as those cash savings, that emergency fund that we talked about. That's really that first component you want to make sure that you fill up. You want to think about this as your retirement planning. So if you're contributing to the 401k today, this factors into that 20% bucket. If you're paying off credit card debt or student loans, if you have anything else outstanding from that perspective, that falls into the savings and debt bucket. So, overall, 20% is a high number that flows into this. Really, if you can look at adjusting that, if you've already got your emergency savings set up, you feel comfortable with where you are there, maybe you say, okay, my savings and debt bucket goes to 15%. And how do we allocate that elsewhere? So this is the key framework that we utilize to say, how do we get our budget under control? How do we understand where those key components are going, what factors we should be looking at? And does this make sense from a long-term perspective that we can stick with our goals to make the best decisions for ourselves and our family? And so this is really that key foundational piece for you from a savings and budgeting perspective. What about debt? So a conversation that I often have with employees that are newly contributing to retirement plans, or the question or concern comes up, hey, I've got a debt load that I'm looking to pay off. I have student loans outstanding that I want to make sure that I pay down. And there are key components to consider when thinking about debt. I'm going to talk about ways to pay down that debt, but I want to also give this an opportunity to be an exercise in psychology, because everybody views debt differently. I'm going to say that again. Everybody views debt differently. Some people are much more comfortable with carrying a debt load than others. And so while I'll give you some foundational pieces to help you understand and put action items in place, understand that your specific view on debt could play a unique role in the way in which you approach things. But as we look at crushing debt, as we'd say, crushing debt the right way. So this is very much the spreadsheet view, right? We want to say, hey, how do we maximize each dollar going in and going out? How do we make sure that every dollar that's yours is maximized to its fullest potential from a earnings and savings standpoint? That's the view that a traditional financial advisor is going to take. So a simple framework is, if you're dealing with a number of different outstanding debt obligations, pull up a spreadsheet or however you prefer to organize things, lay out what's outstanding, what that annual rate of interest you have to pay is, and what your annual or your regular minimum payment is. This is a simple organizational tool to utilize, and it helps from a psychological standpoint to say, hey, where is everything? What is everything doing? How is all of this working together, and what should I focus on? Really high level, it's pay your high interest debt first. Really, the debt load of carrying credit card debt and things that have those high interest rates can really create a lot of heartache. And the quicker you can pay that off, the better. Even if that means, hey, you know what, maybe we take 10% from the savings component of savings and debt and focus on paying down debt first, because we have a high interest rate loan out that we need to get taken care of. Let's get that done now. And what steps do you need to take, and how long is it going to take you to pay that off? Then when it comes to things like student loans and your mortgage, your car loan, those are items that you can use debt to your advantage. You don't have to pay that off today. But those are items that are important components to understand your preferences from a psychological standpoint. So if you don't like carrying debt, maybe you put more of an emphasis on paying down student loans or maybe you figure out a way to pay your mortgage off early. Maybe there's a way for you to say, hey, instead of paying off a 30-year mortgage in 15 years, how do I do it in 20, but still save for retirement? And so those are the considerations I would be thinking about if I were in your shoes is, hey, let's get a clear understanding of my views on debt. How does this make me feel? Does it stress me out at night? Is it something I'm constantly thinking about? Is it an area where I'm losing sleep? Well, maybe then those are some key indicators that, hey, let's put a greater emphasis on this component. Or maybe it's saying, hey, you know what? I know I'm making my regular payments. I know I'm going to pay this off at X date in the future. I feel very comfortable with this. Let's maximize our retirement savings now. That's the spreadsheet view of things. And really the way to say, if you came to me and said, hey, I'm trying to maximize everything that I'm doing, it's if you look at the hierarchy of needs, you're going to say pay off those high interest debt obligations first, and then maintain your regular payments for student loans and mortgage. And how do you maximize your retirement savings? But again, I think there's a great opportunity for you as an individual to explore what makes sense for you, because at the end of the day, it doesn't matter what type of numbers or charts or ideas that I put in front of you. If it's not something that you can stick with consistently over time, it's going to be difficult to be successful. Now, I'm going to be a little bit biased here, but as we look at saving for retirement, I really view this as the star of the savings show. In my personal opinion, I believe that the 401k, 403b, any sort of retirement savings plan that's sponsored by your company is the single greatest way to build individual wealth for yourself as an employee of that organization. So maximizing and taking advantage of the plan today that fits within this framework and these savings goals is going to make a significant impact on you and your financial picture. So why do I feel that way? Well, the 401k allows you to automate savings, right? Everyone that's contributed to a plan before knows this. Every pay period, you're setting up money going into your account. Most investors that I work with within the 401k plan remain invested. There are ups and downs in the market, but because you're buying in each pay period, you don't necessarily have the feel those swings in your retirement savings as much because you're constantly funding it. And then on top of that, there are great investment options that are do it for me options where you don't have to go in and constantly make adjustments to your retirement investment account. So as we're looking at that as a whole, when you're automating your savings, again, talking about rule of thumb as you're reaching mid-career, and we've got our arms around our budgeting, our emergency savings, our debt load, then we're looking at how do we get and maximize our 401k contributions. Really, as an employee, the goal would be to try and aim to get up to that 15% savings rate. Now, if you're sitting today at 3 or 4 or 5%, sometimes making a jump from 5 to 10% contribution or 5 to 15% contribution can be very challenging. So, what can you do to eventually get there? Again, I'm a big proponent of small steps make big results. So think about setting up an option to increase your savings 1% every year. When you're doing your annual goals and setting your New Year's resolutions, the easiest way to check a box is to go in there and bump your savings rate from 5 to 6%. You're likely not going to feel that off the bat. 1% change in your contribution on a per paycheck basis does not necessarily have that significant of an impact. You're looking at as somebody earning $50,000 a year, if you're making a 1% change on your contribution. It's looking at about $5, so $10 a month that you're contributing to your plan. And if you continue to save and invest that 1%, you're looking at a almost six-figure difference in your retirement account balance by utilizing that 1% change. So those small changes have big impacts when you're looking at another 15, 20, 30 years of savings. Another option to look at is you've been crushing it at work, you get a promotion, you get a raise, something that benefits your income. Let's say it's a 10% salary bump that you got year over year because of the hard work that you put in. You could consider doing big bumps at those times versus the 1% change year over year. And you could say, hey, I'm going to take home 5% more and I'm going to save 5% more, or I'm going to put 3% more and I'm going to take 7% more. These are just little cues that you can put in place to say, let's make small changes that don't have lasting impacts on my day-to-day comfort level from a financial perspective, but have long-term positive results on my financial picture. Then all of that money that you continue to put into your 401k is going into the market and working for you. And being able to have an investment allocation that you have comfort with, that you can stick with through the good times and bad of the market, are only going to benefit you. We're going to talk a little bit more about what that means here in the next couple of slides, but something that's important to consider is you're setting up your investment allocation. And if you say, hey, investments are overwhelming to me, I don't even want to have to think about it. I can think about the savings part, but I'd like an option to do it for me. The default option in your retirement account is great. A target date fund is very simple, but strategic and impactful for you as a saver. Somebody that wants that do it for me option is going to be invested more aggressively the younger you are, and it's going to get more conservative as you get closer to retirement. So you're not feeling all of the volatility of the market as you get closer to your retirement age. It's a great option for those that want the hands-off approach to the investment oversight of their 401k and just want to focus on the savings component. Again, we're going to talk a little bit more in detail about investment specifics here shortly. I also want to remind everybody on the call here today that those that are working with a 27T 401k plan that have me as a financial advisor, you have access to one-on-one advice to me and my team. I'll provide opportunities to sign up for one-on-one calls at the end of this, but I want to remind everybody that this is not a sales pitch. It's not something that we're going in and going to be sending you a bill at the end of the call. This is a included benefit of your company's 401k plan. And you have one-on-one access to work with me and my team to get financial advice that's specific to you at no additional cost to you as an employee. So buying a home, I'm going to spend just a little bit of time here, and we do have one more poll question that I wanted to bring up and just see for those that are on the call today, if there was anybody that was going to be buying a home here in the next 5 years. So yes, no, I already own, or not sure are our 4 questions. Again, you should see the poll question pop up. And I'm going to give everybody just a second to jump in and answer that. All right. Just about everybody that has participated in the poll. So again, I love the diversity of financial perspectives that everybody has here on the call today. We've got a majority of people that own, but some people that are looking to buy, that are not looking to buy, or are not sure. And so I think this is a great opportunity to just briefly touch on for those that maybe are thinking about purchasing or have not purchased yet, to have some rules of thumb to think about. Now, I do want to caveat, there are ways for first-time home buyers to access the 401k. And I don't want to say that you should never use that. I have helped a number of people utilize that option within the 401k to purchase their first home. But in terms of maximizing your savings, maximizing your retirement benefits, not touching that money is going to be ideal. So how do you do that? You can set up, similar to your regular savings account, you can set up a direct deposit to a savings account, whether at your bank, a high yield savings account, maybe a brokerage account, depending upon how far out you're looking to save, and doing so on a regular basis. Also, to consider outside of just the down payment, there are other components when closing from a home perspective. You have property taxes that are due annually. You'll have to insure the home. There are maintenance components. If you've only rented up until this point, maintenance on a home adds up, especially if it's something, an older home and maybe has not been maintained as well as one would hope. Oftentimes, you're going to start seeing some larger maintenance costs over the first couple of years as you move in and get comfortable in your new residence and start updating things to fit your needs. So make sure that you've got a pool of money that you can access to make that down payment and be ready for any unintended expenses. And I do think from a financial perspective and investment perspective, buying a home should be viewed through the lens more of security and putting down roots for your family versus being a short-term investment option. I'm by no means a flip type of expert in terms of going into an underappreciated home, fixing it up, and then selling it shortly thereafter for a profit. I know there are people that do that actually live in the home and do it successfully. And I wish all the power to you. But if you're looking at owning the home to live in and live in over a long period of time, it is a forced savings account. You're paying your mortgage versus paying someone else's mortgage, right? There are a ton of benefits for you, but don't get caught up in the, hey, I'm expecting X amount of return on my home. If you end up coming out ahead at the end when it's all said and done, that's fantastic. But don't think of it as I need to achieve X rate of return to maximize my retirement goals. That's not what a home is for. And really, depending upon where you live, where you purchase your home, the changing environment, it is so specific to your individual situation that it's impossible to say, here is your long-term expected return based on where you're looking to purchase. So think of it more as this is for stability and this is for my family or for me to know where I'm going to live for the foreseeable future. Saving for children and education, I think, is also an important component for those that maybe don't have children yet and are thinking about it, those that do and are maybe getting closer to retirement, or maybe you have family members that you're looking to help out with. I think this is a great thing to be thinking about. Education savings can benefit any young child that's looking to eventually go on to further their education. I would say you want to make sure that you've got your budgeting, your retirement savings, all of that in order before consuming yourself with trying to fund college savings for your children or somebody else. Fund your retirement savings first. Once you've started and gotten a good handle on that, and we start looking at budgeting for children's education, a 529 is a great option to utilize. A 529 college savings plan has a ton of flexibility due to some new legislation that's come out. It's actually even more flexible than it was before. So this is a great tool to utilize for your children or the children of family members or people that you're looking to support. I think a great option as well is if you have young children, I know I've got two little boys at home that are 5 and 1. What we did was establish a 529 plan. And when a generous family member gives a birthday gift of cash or a check, we immediately put that money into the 529 plan. My 5-year-old and 1-year-old wouldn't know what to do with the money. And so we are establishing good savings habits for them. And then as they get older, making sure that they know and understand the accounts that they have, the investment options they're utilizing, and involving them in the investment process. But it creates a great opportunity where if you say, hey, maybe we don't need another toy around the house or another book. What if we helped fund our child's college savings plan? What are the benefits of utilizing the 529? You get tax deferred growth. So any growth on the investments that are made within the 529 plan are tax deferred. You get tax-free withdrawals on any expenses for qualified education. What's also wonderful is, let's say you have multiple children and you don't use all of the 529 plan for your firstborn, you can adjust that and roll that into another plan for your second. You also have the ability to, let's say all of your children get through college and you still have 529 money left over. You have the ability to roll that money into a Roth IRA for your child um, without having those any tax penalties, and be able to fund a Roth IRA for them utilizing unused $529. So there's a great option there. It doesn't lock in your money. And, at the end of the day, you can do things like that. And you say, hey, I'm earmarking this for my children. Or you can say, you know what? I'm going to do what I can to pay for my kids. If they get scholarships, if there's money left over in the 529 plan, we'll take the tax hit. It wasn't our money to begin with, and we'll go take a fun vacation or something like that. I'm sure you can get very creative on ways to utilize the money. But there's a ton of flexibility there, especially if you're tax sensitive, to make sure that you're optimizing the account from a tax perspective for you and your goals. So those were the two items that didn't have as many takers on the question. So I wanted to make sure that we at least gave you some foundational pieces, but spend a little less time in that and going into the investment strategies. So from a retirement savings standpoint, budgeting, college planning, house savings, all of these are key components to a well-rounded financial life. But the real magic happens in making sure that your investment strategy matches your long-term goals. Now, this can be overwhelming because there's so much information out there. You'll hear somebody one day say, buy this, and the next day that somebody else that you feel like you can trust is saying, sell it. Do I buy Bitcoin? Do I start buying rental properties? There's tons of information. There's tons of different ways to peel the onion, so to speak. And so utilizing the tools and resources at your fingertips are the key components to being successful when it comes to investment strategy, and then tuning out the noise outside of what your goals are. So from an investment strategy perspective, the lens that I take is, how do we maximize our investment strategy within the 401k? If you're utilizing the 401k to its max component, you want to make sure that your mix of stocks and bonds in the portfolio match your growth goals. For those that are new to investing, stocks are going to be actual ownership in companies, where bonds are going to be an obligation to pay interest and return principal. And it could be from those very same companies or governments as well, or municipalities. But really overall within the 401k, when you're thinking about asset allocation, age-based allocation, it's important to get the mix of stocks and bonds correct. Simple financial planning is going to say, hey, You're closer to retirement, you're going to want more bonds. You're further away from retirement, you're going to want more stocks. Why is that? Well, stocks have greater long-term growth objective or growth projections, where bonds have a lower growth projection. You're taking on more risk, though, being a stock investor than you are being a bond investor. Stocks are going to have the opportunity to grow more, but they're also going to be more volatile than bonds. So if you think about and we'll talk a little bit about what that means here in a minute, but making sure that your asset allocation, your mix of stocks and bonds, matches those goals that you have. And why I keep repeating myself as it pertains to that is because sometimes somebody who is closer to retirement may be more comfortable with stock allocation than somebody that's just getting started. Really, it comes down to your risk appetite and your comfort level of investing in the stock market. To me, the more success you're going to have is being in the correct asset allocation for your specific goals and being able to weather the storm, so to speak, when things pop up from a volatility perspective. If we think back even just to April of this year, we saw some of the most violent market reactions in the last 30 years based on some tariffs that were laid out by the current administration. Regardless of political views, that's not what we're here to discuss today. What happened and what we're discussing is what happened in the market. And what we saw was a very strong immediate sell-off, followed by an immediate rebound in pricing when everybody realized, hey, this isn't as bad as we originally anticipated. But we saw a almost 30% drawdown in some sectors based on that announcement, and it happened in a matter of days. Now, if you're somebody that's going to lose sleep over that, maybe we think about more bond allocation for you. If you are thinking, Will, what happened? I didn't even realize that the market lost that much. Well, that's great. I'm happy that that's the perspective that you have, and maybe you can be in a higher stock allocation. You're going to have more opportunity to achieve longer term growth results by investing in stocks. So the more stock investments you can have in your portfolio, the more growth you'll see. But if you can't stick to the strategy, you're not going to see any growth at all. I'm going to show you why. So this is why I focus so much on that asset allocation component. The chart here that we're showing you today is if you put $10,000 into the stock market in 30 years ago, and you look at December 31st of 2023, the market results that you would obtain by simply sticking through all of the ups and downs of the market. Let me remind you what happened through this period. You had the dot-com bubble burst. You had 2008 with a close to 50% drawdown in the stock market. You had COVID in almost overnight 30% withdrawal or 30% drawdown in the stock market. And you had and all of that, and then you had the bear market of 2022. You look back and you say, hey, I weathered that storm. $10,000 is now $181,763 by doing nothing but investing $10,000 in the market 30 years ago and holding through the ups and downs. This is where the psychology of investing comes into play, because most individuals end up wanting to sell when things get the worst. So what happens is if you miss even simply the 10 best days in the market, what you're seeing is roughly $100,000 difference in your savings account. If you miss the 30 best days, you're looking at almost $150,000 difference in that savings difference. That's a very difficult amount to make up. And the reason why I focus so much on this is because the 10 best days, the 20 best days, the 30 best days, they tend to happen immediately following the bottom of the stock market. And when people pull their money out, they usually wait for better times to invest. That's the quote that I often get. I just want things to calm down. I want them to get a little bit better than they are right now. I want to feel more comfortable when I'm investing than how it feels today. And what ends up happening is you end up missing those days and you end up selling when things are at their worst. And that's part of the average investment psychology component. And I think this next chart really points a very poignant picture of that. And I would argue where we are potentially in the optimism side of this. I'm going to see if I can get this marker going here. And I'd argue that we're right here in optimist where the market is today. We're not anywhere near euphoria, and we're certainly not here at the bottom in terms of despondency or skepticism. We saw a bump off of the 2022 and earlier this year lows, but I think that they're starting to get some more optimism in the market, AI spending, all the fun stuff that you see watching the news. But what ends up happening is as success continues to breed more success, we're going to ride this wave here. And eventually we get to the point of euphoria. No one can do anything wrong. I think that in most recent history, the best way to describe this is think about the 2000s. You had your taxi cab driver saying he was an overnight millionaire by investing in .com stocks. Well, what ends up happening is those .com stocks, they don't have any true revenue and never had any real business model, and they crater to zero. Well, at first people say, no, look at how much money everyone's made. We're good. Okay, maybe something's wrong. Wow, no one's actually made any money. And then things move quickly from there into the, hey, things are never going to recover. I think from here, what you'll see is then everyone saying the next crisis is coming. Growth isn't high enough. Things aren't good enough. We start climbing the wall of worry and getting back to where we are today. So that's taking you all the way from, hey, stocks are good. Hey, this .com thing is pretty cool, to I'm going to make $1 million overnight by investing in a .com stock pre-IPO, to maybe that wasn't the best idea. Oh my gosh, I'm going to lose all of my money. Things are never going to be the same. We're never going to get back to where we were. This is the next crisis. Actually, things are pretty good. This is very consistent over time. This is really the key component of the psychological aspect of investing in the market. So going back to the asset allocation component, that's why you want to make sure your strategy matches that. You don't want to get caught up in this up and down ride. It's going to drive you insane. But if you're able to put the right strategies in place and say, hey, when everybody's freaking out, when everyone's fearful about the market, I know I'm invested in strong companies, I know I'm properly allocated, and I know it's going to return. And that's how you're going to be successful. That's how you earn those market-like returns and reach the growth that we're seeing here on the previous slide of $181,000 over 10 years. Now let me make sure that we get the annotation. We're going to clear all of that drawing off. We're going to move forward. So that's the investment psychology component. I know we're getting close to time and I want to leave time for questions. So we're going to talk about dollar cost averaging. I think this is a good chart to give you an idea of what that means. Dollar cost averaging is just buying in over time. This is very similar to purchasing stocks through your 401k each pay period. And what you'll see is as markets fluctuate, it's actually going to benefit you buying through the ups and downs of the stock market by looking at the total share price here being a little bit higher than if it's steadily increasing, and your average price being a little bit lower. So you're actually maximizing your return as you're buying in each pay period as markets go through their ups and downs that they usually do. So we covered a lot today. I want to say it's never too late to start. Having the right plan in place is what's going to make you successful. And it doesn't have to be complex. It doesn't have to be difficult, but it needs to be something that you can stick with. So what are 3 goals that you can set today? That's my ask of you. Feel free if anybody wants to add it to the chat and have a little bit of camaraderie around the group that's here today. Please feel free to do so. For those that are trying to decide what to do, I'm going to contribute to emergency savings. I'm going to build that up for myself. I'm going to maybe think about contributing more to my 401k or paying down debt. And what are the small steps that I can consistently do over the next year versus how do I erase everything in the next month? How do you take small steps to be in a better place this time in 2026 than you are today? And it doesn't have to be an answer for everything, but if you take 3 things, I think and you stick to it over the next 12 months, you're going to feel even better when we come back and talk this time next year. And when you have that plan in place, there are things that we can control: spending, savings, tax management. There are things we can't: health, longevity, returns in the market, the economy, inflation. Those are all things that we can't control. But really, planning is finding that healthy middle ground and making sure that the uncontrollables are offset by our controllables. And so that's what we wanted to provide here today, what we do to help you as an individual better prepare yourself for retirement. And really, the goal of this whole program, the goal of our financial foundations, is enabling you to spend your money responsibly that aligns with your goals and values, and create some comfort in, hey, I can go out and do the things that I want to do. I'm making progress towards my financial goals. So that's really our key desire here today. And I want to remind everybody, 1, this is my contact information. If you don't have this, put it in your phone. Please say, hey, Will, I have a question on this. Send me an email. The QR code is a link to my calendar. You can schedule one-on-one time, get specific questions answered here. And really, our goal is to help you better prepare for retirement and get into a better financial picture. Reach out to me at any time, schedule time on my calendar that makes sense for you. I hope to have an open dialogue with everyone that jumped on the call today. I want you to think about me when you have questions, and please do not hesitate to reach out to me directly. So that ends our prepared remarks. I want to first and foremost thank everybody for being on the call, and I want to open it up for questions. The chat box is live. It's here for you. I didn't see any questions come through during the presentation, but I want to give everybody time to get in and answer questions that make sense for you. And also, I want to thank everybody that was patient with me as we moved through a little bit of the technical difficulties off the bat. So thank you, everyone. As I wait to see if any questions come in through the chat, I do want to remind everyone that this was recorded today, and we are going to be sending out a recording. So thank you, everyone. And let me know if there are any additional questions that we've got as it pertains to our conversation today. I see a question that came in. Thank you, Amanda, for asking the question. You've got 3 401ks. Does it make sense to consolidate them all? Personally, I say yes. Consolidating is a very good way to kind of strategize holistically from a financial planning perspective. And it allows an easier way, especially if you do transition to another job in the future. You're not slowly adding 401k accounts. You've got one spot that you know where that money is and what to do with it. I'll also add, if you are looking for help on consolidating your 401k plans, that's another great reason to reach out to me. Sometimes it can be difficult to know exactly what information each particular provider needs and how to get that rollover handled in an efficient manner. So please reach out to me if you've got questions as it pertains to that as well. Thank you for the question, Amanda. I'll give, I've, I know we're 2 minutes past time. I'll give everybody another 30 seconds to see if anybody else has any other questions as it pertains to your particular financial planning perspective that you'd like to get answered, or again, you can schedule time with me one-on-one. All right. Well, it doesn't look like we have any additional questions. So again, thank you. Thank you for joining us for our Financial Foundations webinar series. Continue to keep an eye out for my emails. We're going to be ramping up more and more of these educational series. I'd love for you to join, take away what you can. Know that if you can't make it, sign up for them. We send out the recording to everybody that signed up, not just those that attend. Again, thank you, everybody. I truly appreciate your time, and I look forward to working with you on your financial questions here in the future. Have a great day.